Good evening, everyone. My name is Luarka Prasad, and I'm from Tier 1 Capital. And I would like to thank all of you for giving me the opportunity this evening for me to present to you. The subject that I'm going to be talking about is alternative investing, and with a special emphasis on syndicated mortgages, which has become like a hot investment commodity in the last 12 to 18 months. So I just want to take us back a little bit to in the last 30 years of what actually happened in the capital markets. And as you can see, in every decade there was something outstanding about it. Now in the 1980s, we had the decade of the GICs, where GIC rates were astoundingly high, where savers, investors were making 12, 15, 18% on their money. At the same time, mortgage interest rates were very high as well. And as you know, inflation was running rampant at the time. So 1980s was really the decade of GICs. And it was that decade that a lot of people did not invest in mutual funds. As a matter of fact, a lot of people didn't even know what a mutual fund was in the 1980s. But governments started to get very active in managing interest rates as we approached the 90s. And so in the 90s, we saw that interest rates actually came down substantially. And so in the 90s, what happened is that people looking for a higher yield on their investing started to move into a new investment opportunity called mutual funds. And that's when we saw the banks, the insurance companies, mutual fund companies, their growth accelerated during the period of the 90s. In those 10 years of the 90s, we saw investment in mutual funds quadruple during that period of time. So we've got in the 80s, GICs, in the 90s, we had mutual funds. Now from 2000 to 2010, what did we get? We get continuing drop in interest rates, but a lot of volatility in the stock markets, in the capital markets. And that is why after 10 years, from 2000 to 2010, we basically had absolutely no growth in the capital markets, in the mutual funds, in the stock areas. Interest rates continued to decline during that period of time. And that is why it is being referred to as the lost decade. Now, going back to the recent financial crisis that we had, the credit crisis, which began sometime around September of 2007, and it lasted for about a year and a half. We get into 2008, and we saw the alternative investing markets almost took a deep dive. So that market did, from 2007, from 2009, it really bounced back. So let's take a look at what an alternative investment is all about. It's something that is not traditional. It's not your regular GICs. It's not your bond. It's not your stock. It's not your mutual fund. It's about everything that is none of those. So what it is really, it's investing in things like gold, copper, silver, futures, real estate. Those are the things that I consider alternative investing. And what's good about those is that those types of investments have the potential to provide you with really high rates of return. And they're not correlated or not related to the stock market. So if you're looking for a diversification in your portfolio, that is something that's you may want to take a look at. So that's good about alternatives, but there are a couple of things that are not so friendly about alternative investments. And so some of the drawbacks of alternative investing is these investments are not liquid. They're not really transparent. They're less regulated. They're considered a bit more risky. And they're really for sophisticated investors such as institutions and high net worth clients. So these are some of the drawbacks that we've seen with alternative investments. And during the period of the crisis, alternative investments dropped by almost 60%. But let's take a look at what's happening. Since that period of time, these investments have bounced back tremendously, and we saw that alternative investments have actually grown 7 times the pace of traditional investments from the period of 2005 to 2009. What's actually driving this growth? Now, for one, we know that we've had very poor returns in mutual funds and stocks in the capital markets. And so a lot of institutions are looking for, today, they're looking for higher rates of return, which alternative investments can offer. And they're also looking for diversification away from the stock markets and from generally the bonds and the capital markets. So that's really a key, the key drivers of what's happening in the investment markets, in the alternative investment markets. You're finding that a lot of interest a lot of attention is being paid to that market currently. As a matter of fact, at the most recent World Alternative Investment Summit of Canada, which is usually held in Niagara Falls every September, all the major institutions in Canada were there. And they're participating in a really big way. As a matter of fact, many of their investment houses, like CIBC Wood Gundy, TD Waterhouse, they're now carrying a lot of alternative investments for their sophisticated high net worth clients. What is happening here is that the alternative investments are not just growing, but they're becoming mainstream. They're becoming part of even ordinary investment portfolios for people. So we can assume that over the next 10 years, which is what I consider this decade being the decade of alternative investing, that a lot more money would be poured into alternative investments. The institutions have allocated about 25 to 30% of their total assets under management to go into this area. So we know that it's going to be a huge area for investment going forward. So what does that mean to folks like us, ordinary investors? We've got to watch what the big institutions are doing and take a cue from that. Just some statistics from McKinsey Quarterly, September 2012. I think I've just covered that off. The global assets, from 2005 to 2011, rose to $6.5 trillion. The compound growth over that period of time was 14%, which is almost 7 times more than traditional investments. So you can see that the place for alternative investments is well warranted, because there's a lot of focus, a lot of attention that is being paid to this marketplace right now. What's also driving driving this market forward is that we're seeing more liquidity with these investments. They've taken on a new shape. You're finding that a lot of hedge funds are actually improving the way they report their numbers. They're providing a lot more transparency. Now, since the fallout of the credit crisis, the financial crisis, we find that more stringent regulations have been put in place. So people are feeling a lot more comfortable. The institutions are, feeling a lot more comfortable about investing directly into hedge funds. And there's greater acceptance by mainstream. So these are some of the key drivers that we have that are moving alternative investments forward. Cerulli Associates Inc., they've said that asset managers are planning more than 25% of their investments to alternatives. So that's giving it a boost as well. Today, when you talk to financial advisors, what is their story? They're not gathering new assets. a lot of their clients are, concerned, they're frustrated, they're upset about, the state of their portfolios. Many of them today, according to Cerulli Associates, 9 out of every 10 advisors are looking to diversify their portfolio away from the traditional markets as a way of reducing volatility for their clients. So people are looking for alternatives today. They're looking for that higher rate of return. They're looking to find a way to recover the losses that they've suffered in their portfolios. They're looking to make their portfolio lower risk with higher rates of return. So what are some of these main asset classes in alternative investing? We've got agriculture, energy, minerals, precious metals, real estate. You have all the things like options, futures trading, and things like that. But what I want to focus tonight on is really the real estate, syndicated mortgage investments. And I know it took me quite some time to get here, but this is really the thrust as to where I want to take this particular presentation. Now, this syndicated mortgages have become a really hot item recently. The reason for this is because, as I've mentioned, investors are having a hard time getting the right returns for their portfolio. They're experiencing a lot of volatility, a lot of declines in their portfolio, and so they are looking for places where they can get higher rates of return with some degree of safety. These are safe investments because your principal is secure. It allows small investors to get into a big investment play because it's syndicated. It provides a high yield. The values of these investments don't fluctuate. You don't need to be an accredited investor. That means you don't need to be sophisticated. And there is really no correlation to mutual funds. So these are some of the highlights, some of the things that they're saying that are advantageous to these syndicated mortgages. Now let's take a look at what a regular mortgage investment has as some of its features. They're usually an investment from a bank or a trust company. So when someone is getting a mortgage from a bank, to that bank, that's an investment. These are handled by lawyers. When you're doing a mortgage, you've got to get a lawyer to close your mortgage. These mortgages are registered at the land registry. Mortgages have scheduled interest payments. They usually require some down payment, because you just can't buy a house without any down payment today. And for a conventional mortgage, you need up to 20%. And mortgages have rights of foreclosures. So these are some of the features of traditional mortgage investment. Now let's compare this to what a syndicated mortgage is. There's only one difference between a syndicated mortgage and a regular ordinary mortgage. And that difference is because of the amount of participants. In a mortgage syndication, you have 2 or more investors lending their money towards a single mortgage. So in a syndicated mortgage, you will have a group of investors that are investing in a single mortgage. It has the same rights of foreclosure. You have the same registration with the government. You have the same procedures for the mortgage. And those procedures are, you've got to get a licensed mortgage agent in order to do the mortgage, and it's got to be closed by a practicing real estate lawyer. So when you look at a traditional mortgage versus a syndicated mortgage, it's basically the same. Now, syndicated mortgages only work well with real estate investment deals. you wouldn't find it work well with your single residential home. And the reason for that is that with groups of investors and for development deals, it requires a lot of money. That's why you need to do the syndication. But with development deals, it requires, you've got to have very good eyes on what you're actually doing with these deals. So you've got to be able to ask the right questions. As an investor, you have to be able to ask a lot of good questions. As an investor, you become the bank in these syndicated mortgage deals. It's like you are taking your money and you're lending it to a builder or to a developer. So in order to do that, you have to be able to evaluate whether the investment is a good one or not. So you have to look for the quality of the investment, you have to look for safety, you have to look for suitability. These are some of the things that as an investment professional, when you're talking to your clients, these are some of the things that you've got to talk to them about. So you've got to look at the quality, the safety, and suitability. So it really does make sense for having the pros to help on the right and monitor things for you. So many of us are just simple, ordinary investors, and if we're not underwriters and if we're not financial analysts and we're not appraisers or quantity surveyors, it's very difficult to understand what we're getting into in these real estate projects, these development deals. So it is really best advised to leave this to the professionals to handle it for you. Now, not all the deals are the same, and not all the brochures that you'll see out there when you talk about syndicated mortgage investment are really safe. And so what we're saying is that don't listen to a brochure. So you need to actually do your homework here. Many of the entities promoting syndicated mortgages right now says it's a wonderful and perfect investment for everyone. You can recall that in the first slide on syndicated mortgage investments, I said it is safe, it is secure, the principal is secure, it pays a high yield. Yes, these things are all great with good syndicated mortgages, but there are some bad ones too. So you've got to be able to discern, you have to be able to find out which one is right for you. And so you really need the people with sensible and disciplined due diligence and monitoring to actually do this work for you if you are going to be in this area. If you want to invest in syndicated mortgages or do any mortgage investing, you've got to make sure that you really get yourself educated and understand what you're actually doing. And you're going to find if you've not heard of syndicated mortgage investments, you are going to hear a lot about it in the next RRSP season coming up, because it's going to be in your face. It's going to be every other person you talk to will hear about it because it's here to stay. What are some of the ways to minimize risks? Now we know when you do a mortgage, mortgages are registered against the subject property, meaning that when you lend someone money to purchase a property, you have the right to put a charge on that property, and that's what banks and insurance companies and trust companies do when they lend you money to buy a home. They'll take a charge on your property. It doesn't mean that they own your home, it's just that they hold that home for security just in case you can't make payments on the home. Some other protective measures, if you are going to be in the syndicated mortgage business, is to make sure that rigorous underwriting, loan analysis, and information verification is being done. You also want to make sure that the loan-to-value ratio, which is very important in protecting your investment, is well within guidelines. For commercial properties, I recall that any time you're in this particular area, you want to stay on the 70 to 75% to give yourself a really good margin of safety. You want to also make sure that your cycle, your mortgage has a shorter term. You're not going out 5 years or 10 years, or some of the things, some of the investments that I've seen recently, they're 4 and 5 years. So you could be caught in a downdraft in a cycle, a down real estate cycle. You don't want to be in that area. You want to make sure that you can you have access to actually manage that investment through that life cycle. Because we're talking about development projects, you want to make sure that that the project that you're supporting with your investment is pretty close to building out, that is the construction. So site plan approval is absolutely mandatory or necessary, and you want to make sure that the account, the money that's in the account that is escrowed for the project is properly controlled. So these are some of the things that these are some of the questions you need to ask. You need to ask really solid questions, proper questions when you're getting involved in syndicated mortgages. Because really it's an investment for ordinary investors, but you need to be a little bit, you need to get some education, you need to get sophisticated in this area. So a couple of good things about it. I know I've stressed a lot about some of the drawbacks, some of the risks that are associated with syndicated mortgages. They're really good for your RRSPs and tax-free savings accounts and all kinds of investment accounts, including cash as well. The good ones pay very good returns, which is usually between 9 to 12% rate of return per year. And with these investments, you get diversification away from the stock market. So when you're looking at a syndicated mortgage, you want to make sure that it's not occupying a major part of your portfolio, that it's just complementary to what you're currently holding inside your portfolio. So it's a good strategy to take a look at when you're managing your money. We feel that if you have a good syndicated mortgages and all the necessary prerequisites have been considered, you will do very well in the space. But you've got to make sure that your homework is done properly and that you're teaming up with the right people, that the people who know the business are the ones that are recommending this particular investment for you. I just mentioned the rates of returns on these investments. They usually vary from about 8 to 12% a year. Some of them have a profit-based bonus at the back end. And these returns are really in line with mortgage investment corporations. You see many mortgage investment corporations that are year after year, year over year, they're producing returns in excess of 9 to 10%. To let you know, or to share with you, why we're a little bit different from the rest of the pack. All the syndicated mortgages are legal, they're registered on title, they're handled by lawyers, they've got to be sold by mortgage brokers. But we add a little bit of extra security because most of our mortgages are really first mortgages, and sometimes we subordinate to construction financing. As I mentioned at the start of this, we're going to keep it basic because when you're contemplating getting into something like this, you're going to get mortgage information summaries, a lot of details about each project, about each investment. Our mortgages have less market exposure and faster payback. So I'll expand a little bit about this. Our brand of mortgage at Tier 1 Capital, we call it a principal secured mortgage because we believe that we're able to offer good protection, good security for our clients when they invest in these mortgages. Tier 1 Capital is a provider of syndicated mortgages, so mortgage brokers, mortgage agents, referral partners such as insurance brokers, tax professionals. So we work with a lot of industry professionals right now. A lot of them are really finding this to be a very attractive offer for their clients, a very attractive opportunity to give their clients some uptick in investment returns. We at Tier 1 have been involved in about 13 syndicated mortgage deals totaling about $500 million of build out so far. So, and we've been doing this since 2008, so we're not really rookies in the business. So we've got a very elaborate infrastructure in order to take care of this. We have from mortgage underwriters, we have appraisers, we have quantity surveyors on staff. We've got financial analysts that reviews all the numbers. It's an underwriting process and verification process that takes about 6 to 8 weeks before we approve a file. Not every project that comes across our desk we will approve. Our ratio right now is 1 to 7. Every 7 deals that come across our desk, we'll perhaps just approve 1 of them. Yeah. Now for our agents, our clients, we go a little bit beyond the call of a regular business. We spend a lot of time on education, so we say to our folks, why not sit down and learn about this particular investment? It is suitable if you know what you want out of your investment portfolio. You always have to look at our agents, our advisors. They always look at know your client as well. But we do have at our location, on our premises, we do a lot of training and a lot of education in person. We do it in print. We also have classes, and we have a lot of information on our website and online training. And it talks really about some of the past deals, good ones, bad ones, some things to watch out for. We as a company, we like to build better expectations. We're not here to tell you that syndicated mortgages are like GICs, that they have no risks associated with them. They are an investment. They perhaps rank between a bond and a stock. And for those people in the investment industry, you'll know from a ranking of 1 to 10, it's perhaps about 5 or 6 if you know how to manage them properly. We talk about diversification being a part of an investment portfolio. Liquidity challenges, they're just like GICs. You buy them, if you hold them for 2 or 3 years, you're locked up for that period of time. So you've got to understand that they're not liquid. You cannot walk into to a bank or come back into a firm and says, hey, you know what, I want to get out of this tomorrow. Perhaps we've had situations where it has happened and we were able to get the clients out because we are always bringing in new people on these investments. But it usually comes at a little price. We manage the risk on these investments. I would want to think a lot better than most of the outfits because we manage the full life cycle of these syndicated mortgages. From the time our clients go in, we look at it as an asset, so we manage it as an asset. So we're there every step of the way with the project, making sure that things are happening on time, that the project is on track, and if there's going to be variances, that we do have risk response mechanisms put in place to handle that as well. So we begin our syndicated mortgages. We make sure that we get better outcomes because we started with good underwriting, good sourcing, and good verification. If you do that, chances are you'll get to the end game without any trouble. So here's our niche as a company. We are in smaller markets. Tonight I heard Ted talked a lot about Southwestern Ontario and how it actually outpaces the rest of Ontario in terms of growth when good things happen in the US. We are in smaller markets. Our current offerings are in Paris, Ontario, and Brantford. We have in those areas, prices for homes are much more stable. The demographics are simpler. There are a lot of retired people. You find that there's more predictable demand. It's not like Toronto where you can, or GTA where you can, have pretty solid swings over a short period of time. Our projects at Tier 1, they're smaller projects. They're a lot less risk. We don't have, and I'm not knocking condo build-outs or anything like that, but they're massive. They're too massive for us right now, and we don't participate in that area of syndicated mortgages, simply because you need a lot of capital to build out. And I've seen some past experiences where, yes, the condo has been built out, but the owners that started it are not the ones that ended with the condo buildings. During that process, some foreclosures can happen. Some bad things can happen to investors as well, so we stay away from that. Our projects have less complexity. Our builders, they can sell, then build, sell, and build. They'll build a few homes, have them as model homes, and then they will take sales in. They'll take the deposits, and we provide some additional financing. The bank will come in and provide some financing, but you don't need, if we're building out a $50 million property, we don't need $40 million. We perhaps need, the most we need is $10 million, because that capital is revolving all the time for the rest of the build out. Our projects are less tied to the economy. When I say that, we don't have a lot of speculation in our properties that we support. A lot of these properties that we select are very affordable. They're in smaller communities. They're geared towards retirement. We also take greater care in how we handle the paperwork in what we do as a business. We do very rigorous underwriting and verification procedures. We say we have quantity surveyors. These guys go out on a monthly basis and they check what's happening. We got pros that monitor diligently, appraisers, quantity surveyors, and we have very regular communication with our lenders and our investors. We also have trustees and quantity surveyors that watches every penny. We have a fiduciary trustee for every project that we get into. So we cover off most of the bases that we consider that are risky, so that we know that when we recommend something to our lenders, to our clients, that at the time that we offer it to them, it's perhaps the best syndicated mortgage you can find on the marketplace. Most of our mortgages are very short-term in nature as well. So this is how we at Tier 1, we minimize risks. All our mortgages are registered on the subject property at the land registry. We make sure that title insurance is in place. Some other protective measures that we use, we do rigorous underwriting, site plan approval. Now, let me take a minute or a moment to explain what site plan approval is. Site plan approval is an approval from the municipality that you get to go ahead to start building. So you can now apply for building permits and you can go ahead and build. Land development, which is prior to site plan approval, can take years and years to get accomplished. You've got to go through a very tedious, rigorous process there with all levels of government, especially Ministry of Environment. You've got the Conservation Authority. You've got to do geotechnical studies. These things can take years and years. You can have people complain about your property. So we do not get into those properties that do not have site plan approval. When you have site plan approval, it means that you have all your approvals in place to go ahead and build. That way we can minimize risk. We can shorten the timeline for the mortgages as well. So our loan to value ratios are usually between 0 to 75%. Typically it's between 50 to 75%. Our mortgages are usually between 1 to to 3 years. Maximum 3. We will never go beyond 3. Most of what we have are 2 years. We provide full management of the life cycle of the project. We make sure that we're in the game every step of the way. We have fiduciary trustee to represent the clients just in case something goes wrong, goes bad. There are odd cases where things do happen. And we basically guarantee all the cash in and cash out from the project. So we're in total control of what happens with a project whenever we take it on. With syndicated mortgages from Tier 1 Capital, you'll make 9% every year. That's what the builder will pay. You get security on your principal. Syndicated mortgages against mutual funds, there are no management fees. If you've got a good one, you can double your money every 8 years. You don't have markets ups and downs to deal with. Most of them pay regular cash flows. They pay monthly interest or quarterly interest, and you can use it for smart planning for retirement. So there are a lot of good features about syndicated mortgages. I believe that we've got a really good investment product here for our clients and for potential clients. And we also have a program whereby if any financial advisor, insurance agent, mortgage broker wants to get involved with us, we have a referral fee program. Get together with a person who's invited you here tonight and maybe talk to them about it. But syndicated mortgages as an investment product is here to stay. It's not going to go away because the field of alternative investment is only going to get bigger and bigger as we go forward. So now we're running out of time, and I've been going really fast here. So I want to thank you so much for being so patient and for listening to me. And hopefully that there's been something useful or interesting in what I've said tonight. So once again, thanks for coming out and listening to me and to my presentation.